Okay, welcome everyone. Welcome to this session on scanning the market and some candlestick analysis. There's lots of things to go through tonight. I'm going to keep it as short as I possibly can, under 60 minutes if we can, but we're going to get through a lot of little detail-y bits and hopefully find something constructive that we can walk away with after this session. You can go and take some of the ideas and try them out, which I certainly encourage you to do, and I'll talk about that on the way through. First of all, of course, the disclaimer. This is educational material prepared for general guidance only, does not constitute financial product advice, does not take into account your investment objectives, financial situation or particular needs. You must consult a licensed advisor before acting on any information. Now, I'm also going to try and field some questions as we go along. Okay, so we're talking about scanning the market. When we think about scanning the market, we really, first of all, like any endeavor that we do, we've really got to sit down and ask ourselves, well, what are we actually looking for? And what I mean by that is what suits me, because I know a number of things that I might talk about, some people will glaze over and other people will take a bit of an interest in it, and other things, of course, the opposite is also true. So we have short-term traders, long-term traders, that type of thing in the markets. So it's really quite important that you first of all just make yourself a cup of tea and have a bit of a think about what really works for you. So is it the breakout trade, which I'll go through in a moment? A volatility trade, is volatility interest you, both up and down in the market, or indicator signals, as there's a lot of any number of indicators you can bring out, and until they give you a certain signal on your chart, you may trade off those signals. Now, before we get going on here, the daily report, each morning I send out a daily report. Every morning there's a trade in there. When I say every morning, I mean most mornings. Today was just a bit of a report on iron ore, but every morning there's something there to look at, something to take away and really try out, if you like. Write it down, see if it works, see if it doesn't work, that type of thing. Yesterday, a couple of days ago, we had oil search up there. This is it goes in, it arrives in your email like this, on the front of your email. You don't even have to read the email in the background. It arrives on the front page. And just in this case here was, we're looking at oil search. This is the daily chart of oil search. Had the little chart there, had what I was looking at, where the stop is, has the stop loss stated over here, and basically the reasoning behind the trade itself. So there's one area to look in, and take the comments that you read in here and go and test them out, go and try them out and see if it suits you. Occasionally I post weekly charts, but mostly in the daily chart. This is an account of someone I'm closely working with. This is simply the trades we've taken in here, the positions we've taken in here are off everything that I'm going to talk about in the next 30 to 40 minutes. And you can see to the bottom line here, 109 out to 115 in the past few weeks. So we also run the portfolio inside FP Markets. It's available to anyone that wants to go and look at it. It has a series of rules. We've been running it for 11 months. We closed it off on the 29th of October, probably a week too early, but we closed it off on the 29th of October. There's a couple of things that come out of this. One is that there was 45 small losses over the year. There were 17 winners over the year, and it remained up 34% over the 11 months down here, over 11 months. Also want to point out, let me go back a couple of slides. This morning email that we send out, I'm not so much talking my book here, but it really does require you to go and check on this is that if you had bought one share in every email of everything that turned up on your daily email, if you bought one share over the last 2 months, you would have made $11 and lost 5 on there. You would have made $11 and lost $11.02 and lost $5.90. It was about a 50% up on your somewhere in your capital. Now you can construe that all the way around you like. You can go into position sizing and all that sorts of things, but all I'm doing is what's happened in here, what's happened in the portfolio is that we have a large number of small losses and 17 winners. And what it looks like is this. This is available on the website. You can go into the website and have a look under the trading portal on there. Essentially, they're all listed in there. The day we bought them, if you click on there, it'll give you a chart. It'll show you what we're looking at, that sort of thing, and a timestamp on the actual price on the actual chart as a timestamp of when it occurred intraday. But you can see here very quickly that the right-hand column, the profits on here ran anywhere $1,000, $14,000. That was a bit of an outlier, that one. But 3,1860, 1,920, and just a couple of comments there. And then all of the stops are listed there as well, and they're in slightly different format, but just also point out that the stop loss on this trade, $814, $1,000, and $322. So it works out that you can take, by the time you let your winners run, you can take a lot of small stops and end up with a 34% return over 12 months, over 11 months. So where do we start with this? As I said at the beginning, at the top of this, you kind of really have to work out, first of all, who you are with this. Are you a short-term trader? Are you a long-term trader? Are you a position holder willing to wear the ups and downs on a day-to-day basis? Are you a really kind of intraday type of trader, that type of thing. So we can break our scans down into short-term and long-term in there. In the short term, we're looking at daily factors in there, daily breakouts, using daily indicators, that type of thing. In the long term, really comes out to weekly and monthly observations of the market and what we want to scan for. So a better question is ask ourselves what's important. So in the daily scans, what's important in there? The price range of the equity. We can scan looking for equities between $1 and $5 or $5 and $20, that type of thing. And we can eliminate all of the penny stocks. It saves a little bit of time. And minimum volumes, is there liquidity in the stock? And we'll have a look at some charts a bit later and see what this liquidity really means in here. And then the weekly type of scan, again, the price range, we can scan out the price range and look for longer term indicator movements like the RSI, and looking for pivot points in weekly charts to give high probability entries into a trend. We really want to buy into the trend. If anybody's kind of thinking that we sit around trying to, in a sense, pick lows or catch the falling knife, no, tried it, didn't work. You can find scan results in a lot of different areas. You can find scan results in a lot of different areas. This is off the ASX website today. It'll give you basically the gainers for the day, the top 5 gainers and the top 5 losers. So it's somewhere to start. Then we'll have a look at how we're going to analyze those as we go. So that's available on the ASX website, www.asx.com.au. It's on the very front page, on the very front home page as you log in. Then when we look at the scan itself, when we get back to scanning, then we ask ourselves, well, volatility breakout, short term is again volatility, a percentage gain. We can scan for percentage gains over one day over the other, and I'm not here to push any particular software. There's only really a handful that do it anyway, and most of them in the charting packages, that type of thing. And as I said, in the long term, we just want to get on board a trend. We want a weekly or a monthly type of breakout. And I can't stress with you enough that if you're going to hold positions successfully, you must get onto a trend in the market and let a trend unfold in your favor, and that's what we did with the portfolio over that 11-month period. Now, in just going back to that, we got knocked out very quickly. The trade didn't work, got knocked out very quickly, moved on, and basically just kept the ones that were working for us. I do this in every workshop, every seminar that I conduct. I go through this model, and I'm still to this day startled how many people don't understand this concept about price. So you're not to miss out tonight. During the primary phase of a rising market, new highs are made and higher lows are made. A rising trend, this is the important bit, a rising trend can be identified by the way of higher highs and higher lows. So this is what the graphic looks like. The graphic, if you turned your price chart into a line chart, it should look like this, trend should look like this. And the start of a primary uptrend is identified when the price makes a new high after making the first higher trough. So in this little example here, we've got the final low, we've got the high, and we've got the higher low come in here, and a break of this previous high gives us the statement of trend. There is no other method except this. This is Dow Theory 101. It's been around for 100 years, and it is purely price-based, not indicator-based. So there are schools of thought that says, oh, well, if the averages are pointing up, then it must be a trend. Or if the 5's over the 10, it's a trend. Well, no, it's not. It's when the buyers are willing to bid the price up higher than they've been before and willing to take the price higher. That is the only way that you can actually make any money, by being on their side or being one of them and going with the price movement. The same on the way down. The same on the way down. Market makes a high, market makes a lower high, a low in here, then a lower high, and breaks the previous low. And there was a question here about, do you take the Fibonacci retracement? The answer is yes or no. And Fibonacci is an interesting subject, and if you want to work with Fibonacci, the best statement I heard about Fibonacci is you draw your Fibonacci lines on your chart or have them overlaid on your chart, and then you look at the price action. The price action will tell you whether that particular level is going to hold or whether that particular level is going to break. Often with Elliott Wave and Fibonacci, we can spend so much time trying to make the indicators work that we miss the market. Now, I want to just have a look in a moment at some very, very simple identifiable turning points in the market. Excuse me. So a downtrend, high, low, lower high, lower low. Ever ask me around to your place, I'll talk about this. This is what it looks like in price action. So in here we have this established trend up through here. Along the way we have these pullback areas, and then the market starts to move again and pull back into these secondary moves and comes out and breaks this high in here, confirming the trend. Excuse me, confirming the trend, and every pullback that makes a higher low and then goes on to make a higher high, the trend is confirmed until it's not. That's one of the most interesting aspects of trading, until it's not. And that's the bit we're interested in, of course, when we're holding a position. So this trend is still confirming on the way up. We can see in here that as the market turns, the market makes a low area back here over on the left. Market moves up, makes a high, and then makes a series of individual lower highs to form this secondary market until the low is made, and then the spike low in here, the low comes into the market. In the following trading periods, whether it's 5 minutes, a day, or a week, or a month, the market moves out, takes out that particular high first of all in the early stages of the move, then eventually takes out the high in the background, and the trend is deemed to be resuming. Inside, the question was about Fibonacci retracements. These types of retracements, these types of pullbacks can average anywhere between, in Dow theory, they average anywhere between 33 and 66%. It's the average of averages in the market. So what that means is as the market makes a low in here and rallies out to the high, that price distance from the low to the high, the pullback in here in an established trend should be anywhere between 33 and 66%. That basic Dow theory. In there, Fibonacci tries to put a little bit more science behind it, as does Elliott Wave. Don't miss the market while you're letting those, while you're overlaying those tools. So an established trend in here, and it's a trend until it ends. Question is, do moving averages basically detract from the focus on price? Absolutely. Absolutely. The moving average is not going to make you any money. We'll take a look at a couple of things around that in just a moment. This is a close-up look at essentially a pivot point on the high, pivot point on the low. In every turning point in the market, there's one of these established. Whether it's in an important place or a place that you would give weight to or not give so much weight to, we'll take a look at that when we get to some charts. But essentially between three trading ranges in here, if we hold true, let me go back, that this model is true. If we hold true that this model is true, I should say, market goes up, makes a high, pulls back, makes a low, and makes a higher high, then we have trend in place. If we come forward again into here, market makes a high, market makes a higher high and a higher low in the next bar. So trend is in place between two bars, and then the third bar, market makes a lower high, lower low. Within those three bars, you have essentially a change in trend between two bars or three bars. But three bars set up the pattern in there. And the same on the in the lows. What you're looking for is the market's coming down, makes a low, makes another low down through here, and in between there's got to be a high in the bar, of course, and then the following bar makes a higher low and a higher high. So you have this definition of trend in place in what's called a pivot point. Let me go back one slide, and you'll see in these examples here, particularly just here, the 1, 2, 3, third high along, you've got the bar moving up, makes a high here. The previous bar makes a lower high, lower low, then the lower high, lower low following that, and then the market follows through in this case. Up in here, there's another example up here. Market comes out, makes a high, has a weak type of candle in here. The following one is a lower high, lower low, and market forms into a retracement until it forms a low in here, a spike low. The following candle is a higher low, higher high. It's the only piece of evidence that we have at that particular time, and it's all we can act on, and the market makes a further move. Now, that little example, what I would encourage you to do with that piece of information is go away and check it. Go and pull your charts out on your daily charts or your weekly charts, or if you're trading smaller liquid things like currencies, go and check it and see if it works. See if the swing points actually set themselves up in there. So in another example of price action is this: the market has made a high up through here on the left, made a spike high, then produced an inside bar. Then as the close of the following bar takes out the low, the trend has changed. So we have an inside bar giving us a subtle warning here, and the following bar opened with a gap down between the two sessions and took out the low of the spike high bar here, and the market moves down. Market moves down, continually making lows, then made the low down through here, made the lower high from the previous bar, and then the third bar makes the higher low, higher high. You have your pivot point in place, and the market moves out of there. it's not 100%. If you want 100%, I'm not sure where you're going to get 100% from, but it's a applicable methodology onto your charts. So the issue now is that you identify something that might bring you in to take a position in the market. In this little example here, we have got this little breakout candle here, and below here we've got two indicators that have crossed their various signal lines, giving a buy signal in this case, and so we take an entry. Now, I've made a note here that whatever happens after this line is actually a function of your trading plan. It's not a function of what I think or what the market. It's just a function of your trading plan, that if you set your stop loss at a certain level, whether it's underneath this entry bar, whether it's underneath the previous low, whether it's 10% away, whether it's 5% away, then that's what your trading plan is. And then go and do some back testing, pencil out some charts and do some back testing and see if that really works. So the market in this case has moved up through here, and for the same reason there has to be an exit rule out of there. Now, I'm not here to discuss detailed trading plans so much. I really just want to set up the basis for looking at the very beginnings of building a trading plan out of this type of analysis. So in this case here, the statement is that whatever happens after this line is a function of your trading plan. It's not a function of you per se. Now, a lot of people quote trading psychology, that type of thing. One of the most interesting books that you could read on this is Mark Douglas's Trading in the Zone, and that entire book can be summed up on one page where he says at the very end of the book, he said, you can cobble together 20 trading rules, cobble together a little group of trading rules and go and take 20 trades off that little group of rules. And at the end of it, if you've made some money, it really means that your rules are working and it's nothing to do with you. And then he said that if you take 20 trades and you lose money after 20 trades, that really kind of proves out that your rules aren't working or suitable for that market. And again, it's got nothing to do with you. So you build this sequence of occurrences that can occur that would make you take the next step on in executing an actual plan. And so that's what this statement is about. What happens after this line is a function of your trading plan. The market's just the market. What we've attempted to do on the Monday morning webinar is point out that the really what to look for as what might be an exit or what might be an entry in there, and then go away and do some analysis yourself. So that's the method of this little graphic here. So where to start? Now, scans. One of the most popular ones, as you know, is the 60-day high-low scan. We'll take a look at this in a couple of moments. This is a report that was done today. I did this about 1 o'clock today. There we go. And essentially, this is the scan that I produce every morning. We're looking for stock that's over 50 cents and at a 60-day high. That's essentially what it is. Interestingly enough, when you compare this to what came up on the ASX website today, only one of the ASX top 5 stocks actually turned up on the scan. So looking at the ASX site, you'd go, okay, well, they've got these really nice, interesting up days, but are they really the days that we want? Are they really the breakout or the volatility that we want in a particular chart? And we'll go there in just a minute. So when we look at a long-term scan, we can look at simply this scan here. We'll take a look at a few of these as well, but essentially it's just scanning for ordinary shares at a 52-week high. Interestingly enough, today 45 stocks are at a 52-week high, or 52-week high or better. Question here about, do you consider 50% penetration of the previous bar's range as significant to a potential change? No. The next scan here is ordinary shares. So I've scanned here the earnings yield, more than 4%, and a price between $5 and $20. So it gives us something to look at that might suit your underlying requirement for what might be suitable for your portfolio, what might be suitable to basically look at on a day-to-day basis. So these 52-week highs and the 52-week highs and these types of fundamental scans can bring some really interesting results. So a short-term scan again, this is essentially looking at stocks over $1. This was done today, 60-day high, and we'll take a look at a couple of these. Interesting that MIN comes up almost at every turn these days, so we'll have a look at that in a moment. Now I'm going to do some screen switching in a minute. I want you to bear with me while I kind of grapple with the two screens business, but we'll go and have a look at some charts in a moment. As I said, you really have to keep this in mind, that this entry point, whatever happens after the entry point, no one can know what's going to happen after that, but your trading plan must deal with the coming market information on there. So it's, as I said at the very top of this, with the portfolio that we conducted at FP, with the day-to-day stuff that I showed, the count results there, it really is just a matter of pulling out the ones that aren't working very, very quickly and keeping the ones that are working along the way. And we can be quite ruthless. One of the indicators I wanted to look at today, there's two indicators that I use consistently in the market, and I really just want to have a quick chat about what they're actually doing. The RSI, very popular indicator. What it does is looks at the closing price on an up day. It looks at the closing price now and the closing price previous, and does a bit of maths, then divides it by 0.15 and then smooths it out a little bit, and you come up with a value. And then it compares the next, that adds that on to the current value, and then drops one off the back end, and the same with the down close. So it's a summary of the up closes against the down closes on the price action. When you start to look at this on the chart, you'll notice here on the left-hand side that there is a number of down closes in here. The market is closing lower, so simply the RSI is falling away. And in a 14-day RSI, if you had 14 days consistently closing lower than the previous day, the indicator would simply go to zero. And if you had 14 up days in a row, this indicator would simply go to 100. Because it's bound between 0 and 100. It actually stops at 0.15 short of 100. So as we see, what it's actually doing is looking at the closing price over the end periods in the background. And then we start to get these it's essentially a momentum indicator, and we can look at certain signals in there, whether the red line at the bottom here is a 50 line, and so it's saying that it is closing in this particular indicator, half of the periods are up, half the periods are down, so it's in balance. But we're at the right-hand edge, and we really want to notice what's occurring here at the right-hand edge and see this thing move on. So as the market produces higher highs or higher closes, the indicator moves up, and as they wear them down and starts to drop the ones off the back and gathers more lower closes on the front, the indicator moves down this way. So it's simply telling you the closing, the strength of the movement in price action. Very simple observation of it. The other one is a CCI, which I use, which is essentially the same type of indicator. It's a momentum, classed as a momentum indicator. A CCI is really, really simple. When you overlay a 20-period simple moving average, in this example here, a 20-period simple moving average on your chart, the CCI looks at the distance of the closing price away from the average. So as the price accelerates away from its distance from the average, so the CCI rises. And as the price reverts to the mean, which in this case is 20 periods, if the price starts to revert back to that average, then it simply falls away. And as the price, you can see here, as the price touches the average and closes below the average, we can see that the CCI closes below the zero line. And then as the market moves above the average here, CCI runs above there, and as it accelerates away from the 20 period average on here, then so the CCI rises, commodity channel index rises, and so on. So as the market loses its strength, and we can see this really nice swing point in the top up here, this pivot point in the top up here, and CCI is given a little dog leg, so something's cooking, and away it goes and falls as the price here moves below the 20 and the indicator moves below the 0. That's all it's doing. It's a simple reversion system back to a 20 period average. Now, the problem with this being is that there's two common mistakes. One is that people think that because the CCI drops below 0, it's a short. No, it's not, because you have to come back up here and focus on the price action itself. This price action has to give you the signal for a short particular trade. The other one is that occasionally the 20 period average, as prices swing down and prices start to trend down, we might find one in a moment, as prices start to trend down, then as the price swings back over that average, it will actually give you a swing up here and look like a buy signal. So you've got to focus back on the price action. So when your scan throws up multiple candidates, which one do you follow for best bang for the bucks? Good question. I'll show you. Okay, good question. Any reason for using two momentum indicators together? Yes and no. Well, the short answer is yes. I'll come back to my little picture. This is the RSI and this is the CCI, and they can often give signals at the same time. So we've got three pieces of information now that we're acting on up through here, and we can see price has made a move and the indicator has really swung. So it's a volatility based momentum type of indicator. So big move on there has dragged the indicators up and given essentially a buy signal. So there's somewhere to start. That's basically what it is. CCI daily or weekly, CCI daily and RSI daily. Be aware that when you change to your weekly, those indicators change into weekly indicators as well. You can't apply a 20-day indicator over a weekly chart. Charting packages don't go there. Okay, so I think that's, yep, I think that's all I've got for there. Now, bear with me while I try and get some charts up. Okay, there we go. I think that's coming up. Very good. Okay, so now we've got the way that we essentially organize things, or essentially I organize things on my screen, is on the right hand side here I have a weekly chart, and on the left hand side here I have a daily chart. And you may remember that a moment ago we had this up. This came up in the morning email. I showed that a bit earlier. It came out about 4 or 5 days ago and was essentially right here at this break point here, and the stop. The morning email trade ideas always has a stop under the entry candle. When we ran the portfolio, we always had the stop under the entry candle. So the entry candle was this day here, so you would have received it the next day, or the day I looked at it was here on the close of that day, and it comes out at the next morning before market, and the market gets underway. So you can do some quick analysis in the morning there, and it also, if we get a really bad night or something and the thing gaps down, well then there's really not that much to do. So in this case, oil search has moved up through here, but there's a reasoning behind that. The basic reason is, as messy as the chart is, in the background here, before this signal turned up, there was a pivot point back in here. So we had this congestion area through the price action. Price tried to break lower and suddenly swung higher here, had the little doji candle, made a high close candle in here. Let's see if I can drag this out a little bit. There we go. Had a high close candle in here, and the following one had a higher low, higher high. So this is interesting. That might even be the trade there, if that suits your trading style. Then we had this breakout through here. This is interesting, and we had the inside, almost an inside bar, but a higher high and a higher low bar in there. So on the daily chart, this is looking quite positive. It had a chance to fail back in here, so it's looking quite positive. On the weekly chart, at the same time, on the weekly chart, we had this massive spike down here in late August on most charts. The price had broken out of this descending triangle it was forming, had broken to the bottom. The sellers had their chance in here. They were overcome by the buyers. We set the low, market rallies, and then forms this congestion, this higher low area in here, and then essentially breaks out of this area here and forms again this engulfing candle. So it had two small bodies. Let me go back to the daily chart for you. We had these two small bodies in here, and you can see on the daily chart that was this congestion in here, formed these small range bodies on the weekly chart. Small bodies on the weekly chart and came out of there. The other method that I'm that I talk about on the Monday morning webinar is this Kagura method of candle analysis. And the Kagura method is based on a weekly chart. You can take these candle numbers, they don't work in a daily chart. But if you want these notes, you're more than welcome to just email me and I'll send you a copy of the notes. But in the beginning of the notes, I'll just start right up at the beginning. The beginning of the notes here has lots of little examples. This is a daily, the beginning of the notes start off on the daily candles, what they look like. But more importantly, there's lots of examples here. And when you actually work through them, you'll find that the relationship of the daily candle is always around a swing point in here. So a swing point, this pivot point in the chart in there. And there's notes in there about the gaps. And again, swing points in charts, essentially a little double top between the two patterns and so on. So there's lots of examples there that you can go away and overlay current price action and see, wait a minute, does that work? Can I build a trading plan out of this? Is this something, if this occurs in something you're holding, is this something you should react to? But down on the weekly, I'll come back down here to the weekly chart. Okay, so in the second part of the notes is the weekly candles, and essentially what that looks at is we're really interested, in the middle of the range of the week. Now, a week runs from Monday to Friday, not Monday to Thursday afternoon. It runs from Monday to Friday. We're really interested in the middle of the range of the week and how that price action in the following week or weeks acts around this middle price. This middle area here tends to be support and resistance in a weekly chart, not in a daily chart. You can forget about it in a weekly chart. So we group the candles into 8 green top candles. These are the only 8 green you can have, and these are the only 8 red you can have. They classified into particular numbers, and there's some examples in there as well. In the weekly chart of Oil Search, we had this huge number 2, what they call a number 2 candle. But more importantly is that the low back here and the previous 2 small candles here were above the midpoint. And I'll just get this in a bit closer. And I'll turn on my little medium price indicator. So my little piece of software here puts a little tick in the middle of the range. So here, this is the bit we're interested in, is the price above this, the middle of this range. And we can see particularly in the background down here, which was essentially months ago. There's a very large range candle here, and the middle of that range is right here, and everything has stayed above that level. So if you're a long-term trader, you've got to get out your weekly candles and see where the invisible support and resistance is, and you'll find there's a very strong correlation on the weekly half of the weekly range. It's not 60%, it's not a Fibonacci number, it's just half. And as we go forward, there's a little bit of detail in the notes, but as we go forward, we look for the middle of the range. So this is the current week up here, still forming. This is the previous week, and here the middle of the range is $7.92 is the middle of that range, right there. Back on our daily chart, we had our stop loss here at $7.97, which was at the low of the entry of the identification candle on there. For no other reason, that seems like a good idea. What that does is that we will get taken out of this trade very, very quickly, or the trade will move on and do its thing. So the next question is, well, where does your stop go? Now, a number of people would place their stop underneath each low. At the end of every day, they would place a stop under there, and so that if that low was broken, there is a high probability that you'll have a swing point placed come into the price action, and it will simply take you out. And we can see in here, there is a swing point in here that really saw the price action move, even over the up close candles, saw the price action move down here, and there was, as we said earlier, there was a swing point here which produced this rally, and so far we don't have a swing point in there. So we're still looking at that position. Okay. Just bear with me. I just want to try and get through a couple of these questions if I can. Does a 60-day scan show the high at the latest date or at some? Yeah, it scans the current day. Scans, in my case, it scans the last two bars. Are they higher than the previous 60 days plus, basically? Are they higher than the previous 60 days plus? The reason for that, and I might be able to show you here, the reason for that is this type of, we often see as a phenomena of price action, all search charts, really quite a nice example here, and I won't go too much into this, but we often see 3 highs and 3 lows in price action. There's 1 here, 2 here, 3 here. In a low, there's 1, there's 2, and there's 3. So we have this really nice pattern. Something's about to happen. In this case, it broke to the high side out of there, and it would have, at this stage, would have come up on the 60-day scan, but it's really a bit uninteresting because it's had a nice breakout, but closed low here because the range of the day is essentially above all of this price action in the background. So there's a little bit of work to do. Of course, it's not handed out on a plate, but it is a worthwhile thing to have a look at. How could you tell me what chart software you're using? I'm using a little thing called Phoenix AI up there. Doesn't do anything else except charting. You can't trade off it, you can't write algorithms, you can't do anything. It just does charting. Really nice little simple package. So a couple of the other things. I'll stay with a 60-day scan at the moment. One thing that everyone's talking about is the milk products companies. This is something that, again, as an example, you'll see here on the daily chart, this has come up many times on the scan. I'm not sure whether this day would have come up. Let me have a look. So 49 bars, so that hasn't come up. That's really come come up out here would have come up on the 60-day scan. So when it does come up on the 60-day scan, we can see here that the RSI has swung over the 50 level. Always have just one line on there at the 50 level. It's got a bit of volume behind the market at this stage. Then it produced a pivot point in there. Very strong case for reversal. I just want to get that out of there. So it has produced this pivot point here. So the breakout day has produced this pivot point. In a lot of my notes, you'll see, if you read my notes in the morning note, you'll see that often I comment that when breakouts occur, they often come back and test the breakout level. There's a very strong possibility that that's occurred. Except the next day, it produced a pivot point back the other way. We have the low here, we have the higher low previous, the higher low after that, and the higher high after that, very subtly, but it's there, and then simply gapped out, and the market has moved higher out of there. It is in line with an established weekly trend. The trend was already in place in the background here, essentially over the beginnings of this year. You had the low, the high, the higher low, and eventually it broke out and came up on the scan. But you've already got the trend in place behind there. So probability is strongly on your side that this may continue. So I agree with everyone that's had a standout couple of weeks here. Everyone's getting nervous, including the current holders. This is not the place to have a big position. This is not the place to chase the stock. One of the other ones that came up on the scan was BXB. Oh, hang on, I'll do that up here, BXB. Okay, so very simply, BXB also came out up on the scan here. Came up on the scan here at this point on the 19th of the 11th and has simply followed through. We saw the next day really come down and test that kind of breakout, see if the sellers were there, and we simply got this move up. So BXB at the moment has a down close spike high up here and a down close candle. If it closes lower down here tomorrow, produces a lower high, lower low, you'll have a pivot point set in the chart. In the background, down in here, there's a pivot point set up in there. Really nice one. Off the back of this little secondary market that's formed down through here, which had a pivot point at the top, and market's broken out. On the weekly chart of the same stock, we had the consolidation area in here. The market's moved up, market's formed a low in here. Get this a bit closer. Market formed a pivot level here. It failed to follow through and simply formed a pivot level back the other way, and market has moved out up through here, big outside period through here and moving higher. So in the background, we can see in the shorter part of the weekly chart, we can see this trend trying to establish itself here on the right hand side off the back of this downtrend that's occurred over the early parts of this year. And again, I would stress to you that whenever this is a weekly chart we're looking at, there's the pivot points in every turning point in the chart, right there. And but for some reason, traders just simply don't want to see them. And the next thing is that if you see one, you have to act on it. And then I wouldn't take my word for it. I'd go and check it. There. So, in a nutshell, whatever you scan for, whether it's a short term or long term, do a little bit of homework in your chart, look at your price action, and another one that came up, and I'll take a look at this, and we'll finish up in a couple of minutes, is MIN. It came up on the 60-day scan back here 3 days ago. But there's no trending action here in the daily chart. It hasn't got that trending motion. It's got a low down here, a low here, and a low over here. So possibly there's a triple low in the price. This is good. and we've got our resistance level. I tend to draw my lines across the open closing prices, and we've had this breakout through here. So the most obvious thing is if this came and tested back onto that breakout level, or fell back into this gap, this would start to make it onto my radar of interesting things. The weekly chart doesn't confirm the trend. If we're looking for a breakout on the upside, there's no trend in the weekly chart. Simply not there. And you can see by these series of lower highs in the chart, you can see by these lower highs in the chart that this thing is still trending down, and just in that candle there, although it's an outside week, a little interesting, but it made a lower low, and currently we have a higher high in here, but we don't have any trend per se. And I'll just draw your attention, I think I can, back to okay, sorry, back to the, just let this settle down. There we go. I just want to draw your attention back to this model here. There we go. One more. There we go. I'll draw your attention, but it can't be anything else but this. It has to make the low, has to make the high, has to make the higher low, and then break the high. It is the definition of trend. Nothing to do with averages or anything, indicators, nothing like that. So whenever you do your analysis, look for that type of price action in there. Now, so you wait for the weekly low. The answer is yes. A higher low, that is yes. The answer is yes. Are pivot points useful on the indices like the XJO? Excellent question. I'll just usually we'll take a look at the weekly chart. This is the XJO, and we can see here essentially this is a weekly chart, always a weekly chart first. We can see the market's made a top, the old story now, made a lower high and a lower high, and made a series of lower lows on the way down, and then just recently here we made a higher low. So it's starting to get a little interesting, potentially for a Christmas rally. But last week we had this very large engulfing period in here, and has now set up essentially a swing point. We've got the higher low, higher low previous to that, and currently this week so far, this week's not complete, but we've had a higher high this week, and that's all. We don't know whether this is going to be a higher low. It could simply come in and take that right out. The RSI on a weekly basis is below 50. Not a lot of interest in this just yet. For the shorter term traders, today produced a daily pivot level. Today produced a daily pivot point with a spike high yesterday, the high from Friday, and today made a lower high, lower low in there. We have a pivot point in the index itself. You can see it made one here, you can see it made one here, and you can see it made one here. So the message is, and you can see that it often makes them, and there's one here, up through here, and one up through the top, up through here, and they turn up at turning points, and here's one today. So the observation has to be that, is this important to you? And the answer is yes or no into your trading, and it may be worthwhile looking at we've got a great technical market in Australia at the moment. It may be worth looking at your individual stocks and seeing if they're displaying that type of price action, and basically cut the losers out and let the winners run. I'm going to finish it there. There's something else I want to see if I can get onto the screen. We have, is that going to work? We have a workshop in Sydney on Saturday, the 12th of December. We have a workshop in Sydney on the 12th of December. I have to talk my own book here a little bit. It's a Saturday morning. You can register on the website, and we're going to send out an email for this as well. There's a couple of things in here. We'll be looking again at what we've looked at tonight and take it a step further because we have considerable more time. I think we're going to run it for a bit over 4 hours. We're going to look at the analysis side of it, the setups and the breakouts, and then planning some action around that. So there's a bit of a breakdown here. There's a little introductory video thing there, but we'll take a look at this, spotting the trades again, the structure of the market, that type of thing, and really have a really nice interactive day on there. There's a couple of things that FP have decided to do. You're welcome to come to the workshop for free. No question about that. If you choose, this doesn't come to me, goes to FP. If you choose, you can pay $300 up front, and with that $300, FP will deposit $200 into a trading account of that $300, and those that choose to do that will set up weekly sessions, private weekly sessions, to create a work in progress with myself. FP will fund $200 in your account. You'll receive a full set of the FP trading material, the branded material. We've got a trade calculator, a spreadsheet, very simple spreadsheet coming out. You'll receive that. You'll have dedicated dealing desks, so the guys on the desk, you can have dedicated time with them as well. Reserve seating, that's like business class. Yeah, reserve seating, I think. I'm not sure. A full set of notes, of course, on the day. Everyone will receive that. And as I said, a trading dashboard as well. So that's in Sydney on the 12th of December. Everyone's welcome. Look forward to seeing everyone there. I'll leave the webinar here. Thank you so much for coming out. I'll just point out, see if I can get my... this has been recorded. I'll get it up onto the website first thing in the morning. So if there's anything you want to catch up on, I'm in Perth. How can I benefit from this session? Talk to FP, and I really like Perth. Perth is a great place. Love going into Perth. There's your answer. Is a recording? Yes, there's a recording. Let me go through some of the questions here. Yeah. Oh, there's question. Sorry, Peter, I missed a question on XRO. Is it too late to enter? We picked XRO at $12.90. It was came out in the morning email. It's now $18 or something. Been a really nice mover. Do use volume for RSI plus RSI. Volume's incredibly important. It's so long as the volume is average or above average is the important part, and even for stocks under $1. I was following your portfolio when you're starting another one. We had a big conversation about it today. We are going to start another portfolio. I simply got bored with the other one. We're going to start another portfolio very soon. I'm going to change the rules a little bit just to make it a bit more interesting. And other questions? Is the software available? As I said, the software that I use is Phoenix AI. There's some very good software around. I don't have a preference for any of them. Really suit whatever suits your budget. When you look into your software, make sure it has some basic scanner in there that will save you a lot of legwork. Or if you take the 60-day high-low scan out of the morning email, just do a bit of homework on that. For those that aren't receiving it, you just need to register on the website. Do I still use the EWS and Breakout Fast? The answer is yes and no. Occasionally I take a look at that to see where things are in context. Will there be a long-term PF? Not sure what PF is, Jeff. Any possibility of doing a 4-hour trading course again during? Yeah, absolutely. Yeah, it's really up to FP what they want to do. I would, any chance doing a long-term yeah, probably not a bad idea. Long-term portfolio on a short-term portfolio, not a bad idea. Yeah, that might be actually a good idea. So doing a 4-hour trading course, yes, you really have to petition FP for that. I've got a number of other things I do besides FP. So it's really, can I email you the candle setup? Yes, I should have a set of notes there, but I can send them to you again on there. And that's all. I'll thank everyone very much for coming out. And I was going to mention my email. See if I can get this up. Bear with me a second. I will